Looking to boost your financial modeling skills? The Advanced Financial Modeler Accreditation is designed to help you strengthen and validate your financial modeling skills. In the AFM program, you will become an expert at building a world-class three-statement financial model of a company from scratch. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about managed futures with Andrew Beer. He is co-founder and managing member at Dynamic Beta Investments, which runs IMGP DBI Managed Futures Strategy ETF. DBI launched its first hedge fund replication product in 2007 and today manages over $2 billion. Andrew previously worked at Pinnacle Asset Management and Apex Capital Management, and he got his BA and his MBA from Harvard. So welcome to the podcast, Andrew.
Thank you so much for having me.
So I think this is really interesting because I was reading about you all. You were among the first to bring a hedge fund replication product to the market back in 2007. And you've been doing something similar to it for a while. So I think a lot of CFA charter holders who were on this call would be exceptionally interested in hearing what you've learned in the almost 20 years of doing this. What are the key things that you learned to do or not do?
There has been no good way of getting index-like exposure to hedge fund strategies, right? That's been one of the big central issues. And so in the 2000s, as the hedge fund industry started to become institutionalized, allocators started to ask, well, just give me the space. How do I get exposure to the space? And so the first iteration was, well, just give your money to a ton of different hedge funds and it's going to look like the whole space, but that's expensive. And you've got to have enough money to go and hold the different hedge funds, et cetera. So in the early 2000s, there was this, what turned out to be a fairly terrible idea called investable hedge fund indices. And so what they found was that these firms launched these indices and they found that, well, actually it wasn't represented the whole industry because anybody who was good didn't want to be part of the indices. And so they were just terrible, right? So I had a chance meeting with a quant in August 2006, where he basically described, I'm not a quant by background. He was looking for somebody to get behind his business. I'd been involved in seeding a couple of hedge funds. And he basically said, we've got this thing that's kind of bizarrely simple, which is that you can pretty much just figure out the big exposures of a portfolio of hedge funds and copy it cheaply through a handful of liquid instruments and, using basically a risk model. And I knew enough about factor modeling and factor decomposition. And I'd been in the hedge fund industry. And look, when hedge funds figure out a trade like subprime, like the value and small cap trade of the .com crisis, it's not a surprise, right? And people talk about this stock or that stock, but the whole industry has always been about getting the big trades right. And so what he was basically saying is we don't have to invest in hedge funds. We can do an end run around it. Let's just figure out how they're positioned. And let's try to copy it cheaply. And so what I loved about it was this idea of this is how you bring the idea of, because when you say I want index exposure to the space, you're really looking for a couple things. You want to eliminate single manager risk, get broad-based exposure, but ideally, wouldn't it be great if it was liquid, low cost, in an ETF or other kind of vehicle? And so the irony is, I'm sure listeners have been looking at BlackRock buying a database company called Preqin. And Larry Fink came out and said, we think it's time to index the private equity world. Guys, call me. Okay.
Okay. Well, Larry Fink listens to this podcast.
Okay. Larry, call me. Let's talk.
Yeah.
So in a sense, what he's saying is what he's describing is the fact that the world is moving to model portfolios. What matters is how much you have in stocks versus bonds. And within those categories, how much you have. That matters much more than which guy you hire to manage that 5% sleeve of your portfolio. And in that world, what he's basically saying is there's a frontal assault on manager selection. That manager selection is an efficient process. It doesn't add value. It's expensive. And so what asset allocators really want is a way to say, I want exposure to XYZ strategy. And then just give me that. That's what's driven the growth of index funds in the traditional space. So we've tried to, now there's no perfect way of doing that. Our approach is basically is trying to emulate what they do with a very simple liquid portfolio. And if we do that right, then it has two potential benefits. One is we tend to outperform hedge funds, which is really embarrassing, right? But the answer is that if you can copy most of what they do, but do it cheaply enough, and you're being compared to some guy who does a little bit better than you before fees, but worse than you after fees, and is illiquid, et cetera, it's kind of embarrassing for people. And then you can also put it into vehicles and end up being accessible to a broader audience. And so in a sense, what we're trying to do is make this idea of democratization of alternatives, but actually make it a positive experience, because if you look at the data, most of the things that were thrown into mutual funds never should have put in mutual funds in the first place.
Yeah.
So
And you don't find out about them being in there until a little while later.
yeah, look, I've made a lot of friends in this industry by calling out things that I didn't think would work, and it's hard to get this right.
Well, yeah, it's okay to make fun of mutual fund managers because they did get the 401k decision, right? So, like,
Exactly.
that
They
was
still have their walled gardens.
they're good.
Yeah.
So, I mean, so this is exceptionally interesting. So, what types of things did you learn along the way? Because you were early. Were people ready for that?
No, they hated it, right? Because when you have an industry like hedge funds, right? It's and this was always so curious coming from the hedge fund industry. Was I didn't know as much about the allocator world, right? And as I started to learn about the allocator world, they would say things like, well, we like hedge funds because they're nimble. It's like, which hedge funds are nimble? Like, I mean, like, legendary stock pickers buy stocks and want to hold them for 5 years. Like credit managers aren't whipping around their positions. And or there's all the short side alpha. There was all these kinds of like canons of the industry. And what I've realized over time is, you say about kind of mutual funds, right? I mean, people talk about ETFs as though they now represent 90% of the assets. They're still much smaller. Maybe they're roughly the same size now as mutual funds, but this has been a 30-year process, right? And so what I realized in the hedge fund industry is that people invest in what they want to invest in. And if you take a job as an allocator and your job is to pick hedge funds, you're probably going to pick hedge funds because you like it. And somebody comes along with I mean, imagine somebody walks in and says, I can, in essence, do better than your whole portfolio at a quarter of the fees, not with daily liquidity, no blow up risk, no gating risk, none of these other risks that you're end up taking. 9 out of 10 guys, if their job is to pick those hedge funds, are still going to do that. And so that's the issue that I ran into for a long period of time, which is why I focused on I started about 8 years ago focusing on the wealth management space, because those guys had a constraint in that their clients care about fees, they care about liquidity, most of their clients can't invest in actual hedge funds. So I wasn't competing with people where they would look at me and say, you're threatening my job.
Right. And they're always hungry for a different option for their clients so they can differentiate their firms.
Exactly. Because for them, they can't compete with Vanguard on a 60/40 portfolio. They can't say, we're putting you into exactly what Vanguard will give you for free and charge 100 basis points for that. Right. So they have to try to do better by adding in various things. The problem is that they've for like 12 years, they've added in hedge fund type strategies that in general have sucked. And so they've been penalized for the effort of diversification. And so I've written a lot about this space over a dozen years. If you know hedge funds, a lot of the mistakes are predictable. A lot of the landmines are avoidable. And so what we've tried to do is basically say the world is going to need 60/40 will move to 50/30/20. How do you fill the 20? What do you want to fill the 20 with? And it's getting that right, and so that people can put things into that 20% and be happy with it 5 years later.
Okay, yeah, this is one of the things that I did thought was exceptionally interesting about speaking with you about. But when you say 60/30/20 or 60/30/10, you have to remember that the CFA charter holders who are listening to this, the curriculum teaches 60/40. So take a pause here. Just get ready, everybody. Things change. So this is kind of like the talk we had when we had the Bitcoin manager on here. Is that you can feel all kinds of ways about it, but it's coming. So there's this massive discussion going around asset allocation, right? So what are you thinking about it?
Let's take a step back, right? So 2000 through 2020, right? Diversification, in retrospect, if we'd known about this, right, diversification was really easy. You buy the S&P 500 and you put bonds next to it, you end up with 60/40, right? So the popularity of 60/40 was not a theory that people just loved and adopted. It was supported by the fact that it worked so well, right? And I mean, you look at bonds over that period of time. Now, bonds, and the real reason was we had this very 20-year bull market in bonds underneath the surface, right? That bonds over that 20-year period of time have a Sharpe ratio of 0.9, double the historical average. Max drawdown of 3.8%. I'm talking about the Bloomberg US Ag. 300 plus basis points return over cash. And it's negatively correlated equities. You literally, it was the Superman of diversifiers. It was unbeatable, right? And so that's the point that I was saying about whenever anybody would say, well, it can't go on in 2015, this can't continue, rates can't go lower, et cetera, et cetera. You know, inflation's going to come back, all these other things. Every time people would make these decisions, which I'm sure they thought was the right decision at the time, 3 years later, they'd be embarrassed by it. So in that context, though, the real driver of diversification in a portfolio was this inverse correlation between stocks and bonds, and the fact that both were doing very, very well over that period of time, right? So you're firing on both cylinders. They just happen to be firing at different times. So the Sharpe ratio of a 60-40 portfolio got ridiculously high. The correlation, volatility, I mean, the volatility, everything about 60-40 portfolio looked like a top decile hedge fund strategy. That's all changed with the return of inflation. And so, but what the point is that people have been adding diversifiers. The problem is the diversifiers have either been very equity-like or very bond-like. You know, so we're gonna add junk bonds. Well, that's not all that different. You know, we're gonna go from the S&P 500 to private equity. Well, you can pretend it's different. It's not really different. You can go from bonds to private credit. Again, you have the same underlying economic drivers. So you had this two-legged diversification stool. The problem is that now, last year, the stock and bond correlations were 0.9, right? And it's been that way since inflation came back. And very, very smart people who've looked at a century of data will tell you that if inflation stays above 2.5%, stock and bond correlations will be positive. So there is no diversification anymore. Everything's this kind of big one-legged stool. That's where I think the demand for what fills that 20, some of it is going to have a good story as to why it's differentiated, because it's infrastructure that's got an inflation hedge or something built into it, or it's real estate that looks and feels different, even though REITs aren't any different than anything else. It's MLPs, whatever it is, commodities. But actually, well, commodities are actually different, right? They actually do march to the beat of their own drum. So the big thing for us was we were actually thinking about this back in 2015 and saying a typical hedge fund portfolio, if you don't have to invest in hedge funds, you look at a typical diversified hedge fund portfolio, it's not that interesting from a diversification perspective. Equities go up 10, they go up 3 or 4. Equities go down 10, they go down 2 or 3 or 3 or 4 or something like that. It's like, it's not, they're going to move up. They have high correlation. Most strategies have very high correlation to equities. The one strategy that we thought was both something that was really valuable for it as a diversification to both stocks and bonds was something that we thought that we could replicate or copy cheaply. It's something called managed futures, which also happens to be one of the most reviled investment strategies I've ever seen. And so my great task is to try to make this otherwise, hitherto unlovable thing into something where people look at it and say, God, I'm so glad I have that in my portfolio.
Right. But managed futures, as far as I know, and this has been I've been around for long enough to remember other times when the correlation between bonds and stocks approached 1. And I do remember managed futures becoming a thing during each of those times because of, tell us about why now.
Well, so if you look at the long-term data on managed futures, whenever you're looking at one of these strategies, you're looking at an index of people who do this for a living. So an index of hedge funds. There's an index called the SocGen CTA index, which has been around since 2000, and it's the 20 largest guys. So it's every year SocGen tells you these are basically the 20 juggernauts of the space, and every day they tell you their net of fee returns, their average net of fee returns. And so you've got great data relative to most hedge fund strategy. You've got great data. You can look at that data back to 2000, and oh my God, it's valuable. It has no correlation to either stocks or bonds. It goes up during the dot-com crisis. It goes up during the GFC. It goes up 20%, even after all hedge fund fees in 2022. And So you have no correlation to stocks and bonds. It goes up when you need it the most. And like that, you run your mean variance optimizer or whatever, you're 20% of a portfolio with this thing, right? And it's 6% of the overall hedge fund industry, which for an institutional investor is on average, that's about an 8% portfolio allocation to hedge funds. So you've got one of the most valuable things you can put into your portfolio is capped at a 50% allocation, 50 basis point allocation, right? And when you go into the wealth management world, where because you've got mutual funds and ETFs that do it now, we run the largest ETF. Okay, we are 1 basis point of the ETF world.
Right.
For by our measure, if you run our numbers versus we have delivered more alpha per dollar of investment for our clients in the 5+ years that we've been doing this in this ETF, and we're 1 basis point. Like this should be the easiest allocation for people to make, and yet people struggle with it, and that's what I find fascinating.
Well, so why do you think people struggle with it? Is it because they perceive a trading risk? Because that was one of the things I've heard about it in the past. That there's you can get squeezed by trades because then it's then trading in the assets.
So people throw out a lot of reasons for it. This back when you're talking about, the 1990s when people were doing this stuff, this was also I hope this is everyone cover your ears. It was an absolute fee orgy, right? It was strip out as much money, 10 points a year. We're going to strip out of this thing, and we're going to pay wealth managers to stuff it down their clients' throats. I mean, it was a really sketchy business, right? Then what I've been talking about for the last couple of years is the people who talk about the space, they tend to be engineers who like to talk to other engineers. And so they're very much wrapped up in the language of, my model's better than his model. And he's stupid for not trading a carbon swap that it kind of misses the point that people want to understand why I should have this. Now, here's why I actually think, because the math is so obvious it should be in your portfolio. Here's why I think they don't do it. And I'm introducing this in this. So this is a big revelation. It shouldn't work. It shouldn't work the way that it does. Okay, what do these guys do? Right? They walk into the office and they have a whole bunch of models that do nothing but analyze the past performance of, let's say, 50 different futures contracts, or maybe 100 different futures contracts. And in general, if something's going up, they buy it. If something's going down, they buy it. Okay, except, right, for the average CFA charter holder, they've been told that that's a terrible idea. That's charting, Fibonacci this, Bollinger Bands. It's all of the chartism, technical analysis voodoo that that cool allocators don't walk into their investing committee and say, I think we should buy NVIDIA because it broke through its 50-day moving average. They want to go and talk to a guy who's going to say, and so the whole definition of alpha, again, going back to this kind of like all the weird myths of hedge funds, the definition, the narrative around alpha is some undiscovered opportunity. The alpha is finite. There are only a certain number of things where somebody can find that special piece of information and find that stock that they haven't kind of figured out, that underlying asset, that's clever way of looking at it, right? But since alpha is finite, you got to find the best guy. And in managed futures, the trades are in plain sight. Oh, the yen's going down. These guys are piling into the yen. And so it hits on all of these. Its advantage is that it hits on all of the things that everyone who has a CFA charter is trained not to do. Don't chase something that's going up. Don't dump something or sell something even though it's going down. The world is framed around intrinsic value, a fundamental value to things. Things will revert to the mean over time. And so what it does is the alpha in managed futures is so fascinating in that 98% or something of investors out there have slow moving portfolios. 60-40, right? If you are in a 60-40 portfolio, it's not changing over time. Maybe the composition of the 60-40 or like the underlying assets will change somewhat over time, but every institutional investor has 10-year capital markets assumptions, 20-year capital markets assumptions.
Right.
They are, by design, they don't move slowly.
Right.
But sometimes the world changes faster.
Right.
And so in 2021, I wrote a paper on inflation coming back. It wasn't my idea. I listen to an interview with Stan Druckenmiller, one of the great macro legends. Generally don't trade against him because he's really not dumb at all, and has made billions and billions of dollars. And he had described inflation coming back. And I wrote a paper basically saying, it's worth paying attention to this. And if he does, by the way, managed futures is going to be a great place to put your money. And I went out and talked to a lot of people about it. And I realized that even if they were 90% certain inflation was coming back, they wouldn't act on it until the fire was already burning.
Right. Because remember those people you mentioned earlier who did it in 15 were embarrassed 3 years later?
Yep.
There was a long precedent for that because it was so long, right?
And it kills your business, right?
Yeah.
It's like, and
Yeah.
like if you make a big call like that, and that's why people are so benchmark centric.
Right.
And so what I realized was like that there are these periods of time when the world decides the smoke is coming out of the windows, and people say it's, whatever. People ignore it. They have to ignore it until everybody moves en masse. There's been an 18-month period of time just watching these portfolios where nimble macro investors, managed futures funds, and others were able to capitalize on this rise in rates. So in a sense, the alpha generation of the space is the deliberate slowness of institutions that hands it to this particular area. So now think about that. You're one of those guys, right? What better diversifier for you than the moment when when you cannot act because you are by mandate basically not going to respond to some macroeconomic regime shift? Shouldn't you have that thing in your portfolio that will respond? So that's the anyways, my whole point is I think people think about the space in completely the wrong way because they think about it on a very granular trade level and who builds the models and how they build models. I think the way they should think about it is as a strategy. You'll be hard pressed to find something that's more valuable than this. When I look at data on this, it has more alpha generation than those multi-strategy hedge funds that you talk about. It doesn't have as high a Sharpe ratio. It's more volatile, but you don't pay 8 points a year. You don't type your money for 5 years.
Well, yeah, right. There are other things. There's a couple other things.
A few other issues.
In like lockdown or something else. Yeah. Right.
Yeah.
You can't get them until next year, and then you're so darn happy you'll pay an extra 50 bips for it. It's quite an appealing business. Well, okay. So I mean, I think that one of the things I think you've piqued a lot of people's interest. If I know the listeners to this podcast well, where can we find those papers?
Oh, well, so some of them, I mean, the stuff I've written on liquid alts, you can find all of them. We have our website, dbi.co, which has a lot of the stuff I've written about the broader liquid alt space. I'm actually writing a lot of this stuff now. I've come across this as I've been talking to wealth managers. It's been an evolving thesis. I'll be writing about it over the next couple of months. What I would suggest anybody who's interested, reach out to me on LinkedIn. I'm easy to find. I periodically go into Twitter until I get nauseated and then stop and retreat back into my more genteel world of LinkedIn. But look, as I do stuff, we'll post it there. Sort of this broader question about managed futures and how to think about it. That's an evolving thing that I'll be writing a lot about over the next few months.
Yeah. It sounds like it is in a nascent stage of that evolution for sure.
Hence my stumbling over sentences. In 3 months, if we had done this, I would be perfectly succinct, and I would have my thesis statement all ready to go.
Succinctness does a lack of succinctness here on the podcast should give people an idea that this is coming and this is something where they need to be. So Andrew, thank you very much for giving the members a chance to think about this and a chance to follow up and read your papers.
Thank you so much. Wonderful to be here.
And thank you for the listeners to this podcast. Until next time, I'm Rob Rowan, and this has been Compound Insights.